Hi everyone, I'm Simon Lee. I'm an associate here in the Runway company in the High Growth Practice Group. My pleasure to welcome our two guest speakers today. We have Win Baer from Managing Director at Silicon Valley Bank. He's made his way up from Boston today, so we're fortunate to have him here. And I'm Marta Rochkin, who's an associate in Osler in our financial services group. He does a lot of work with banks and a lot of work with startups as well, so she's going to be a valuable resource and be able to weigh in on this. So today we're going to be speaking about venture debt. Most of startups, if you think of financing, you think of equity financing. As companies scale and have revenues, there's another option, and that's venture debt. So we're going to be covering that topic today. So with that, I'll turn it over to Win and Marta.
Sure.
Yeah. So,
far away. Yeah.
Welcome everybody. We will go through the presentation. There will be a Q&A at the end, but at any point that you have any questions, feel free to just interject. The extent we can make this a conversation and make sure we're addressing any of your concerns is a priority of ours. So yeah, feel free at any point to just ask away any questions.
Yeah, I mean, absolutely. I would say let's try and make it interactive if possible, and definitely, again, thanks to Simon, thanks to Chad, thanks to Marta for inviting me to do this. There's, I'm assuming most companies here are Osler clients. If not, you should talk to Chad or Marta, but there's a ton of overlap with Osler's client base and Silicon Valley banks, so they've been great partners to us, and it's a pleasure to be here. This deck, which I'll use kind of as a loose roadmap, this will mostly be conversational, but try to encapsulate some of the stuff in a few slides. And it's always a little difficult to calibrate, and so the intent at least is for this to be pretty high level with regards to debt. That's the intent at least. If it's too simple, somebody jump in, let me know, tell me to advance it up a bit, or if it's too detailed and I'm nerding out talking about debt and banking terms, I'm starting to sound like a banker, like stop me there too. There's nothing that's like too simple to address in this discussion. So it's pretty simple. I'm gonna maybe give a 30 to 90 second overview on Silicon Valley Bank for those who don't know us, but I promised Chad and Marta that this is absolutely not intended to be an SVB commercial infomercial. We really want to talk about very objectively and agnostically about what debt options are available, at least from what I see, to early stage tech companies. Key considerations, who are some of the players, who should you talk to, what form does debt take, what does that look like, and all that good stuff. And look, by no means is this going to be totally comprehensive or complete. In fact, Marta and I were just talking before we kicked off, I recognized one pretty meaningful gap in here, and so I'll add a couple things in here that aren't on the slides. But if any of you from your own experiences, either want to call bullshit on my facts or add other ideas or options, you won't hurt my feelings one bit. So fire away, please. Anything else before we jump into it?
No, I think we can go right in.
Okay. So, as Simon mentioned, so I'm Managing Director with Silicon Valley Bank. Even though we're headquartered out in the Valley, I'm based in our Boston office, and I run our Canada practice on a national level. So I'm supported by two teams. One is in Boston that helps me cover the Ontario and eastward, and then we have a team in Seattle that helps cover BC and Alberta. For those who don't know us, just most simply, we're a full-service commercial bank that is very exclusive to a certain set of industries. So we don't do retail banking, we don't do real estate, we don't do natural resources-based banking, all the stuff that traditional banks are really, really good at. That's not what we do. What we have done for 33 years is work exclusively with companies in the innovation space, and so generally that's going to be, as you can see from the slide, tech and all the niches that might encompass life sciences and healthcare, VC and private equity firms. So to put that in context, probably 60% of all the VC firms in the U.S. bank with us, and a lot of their portfolio companies also work with us. The one caveat to this whole innovation space rhetoric is our wine division, which we bank premium wineries on the West Coast. And sadly, I've got nothing to do with that business. But if any of you are heading out there at any point and you're wine enthusiasts, shoot me an email, give me a call, and if there are particular client vineyards you want to go see, take me up on it. So a couple of quick stats, and then I'll get off the SVB specific comments. It's funny, and Simon mentioned today, we'll talk a bit about venture debt. Venture debt is something we're very well known for, and we're the most active bank in the world in terms of venture debt. But we do far more than that on the debt and banking side. But with venture debt generally being predicated on VC backing, the two stats in the bottom middle shouldn't be a big surprise. 50% of all the VC-backed or tech and life sciences companies in the U.S. Are SVB clients, and then 58% of all U.S. VC-backed companies that had an IPO in 2016 were SVB clients. So that's that bottom stat that's when everything works out beautifully, where we've gotten involved early with a company, but grown and scaled with them and stayed with them to IPO and or beyond. Our clients would range from early stage seed-backed, angel-backed companies all the way up to public companies. Again, the common thread, wine division aside, the common thread is they're all in the innovation space. So that's just sort of a quick backdrop on SVB and maybe what makes me halfway qualified to talk about some of this stuff, but that's really the end of any SVB specific comments that I'll try and make here. And you guys will get copies of this. There's no need for me to run through this, but just to give you a flavor of kind of what our client base looks like, here's a sample set of some of our clients. Here's a sample set of some of our Canadian clients that we're very proud of. And now let me get away from SVB. So actually, in reading this, I was a little hesitant to even title this slide Debt versus Equity 101, because it's, as we often tell our early stage clients, we're not looking at trying to be a substitute for equity per se. In fact, like the two, the key is striking that right balance and figure out how do they work well together. And debt certainly can be very complementary to whatever equity you're raising. This, again, might be too simple for some, but for others who aren't as familiar with debt, just quickly kind of point out what you're looking at here. On the left side, just look at this as a simple kind of risk return type stack where debt and senior debt which is where we typically play, lowest returns but lowest risk. Equity, particularly common shareholders, highest risk but potentially the highest return. The inverse of that, of course, is if you go, and why is that? Well, if you go to the right side in terms of who gets paid first upon an exit, which you hope is a good exit, but even in a downside scenario, who gets paid first? Well, the debt folks, got to get their money back. You hope there's money left over for the shareholders, and in good situations, there's the lion's share is left over for the shareholders. So that, again, kind of a simplification of debt and equity dynamic. But if there's any questions or if that doesn't make sense, let me know.
And I think one thing to point out, when you're dealing with venture debt, as soon as you're looking to financial institutions, I would say 99.9% of the time they are looking to take security. I think, it's got to, even multi-billion-dollar companies usually still have to get secured debt. So as you're looking to someone like SVB or their competitors, taking security in your collateral will be a requirement from them, putting them again to the top of the charts in terms of the repayment priority.
Yep.
Are you going to talk more about the type of security that you're able to take?
Sure. Yeah. In fact, we'll kind of jump to that, and this isn't entirely related to that, but I'll add some more details. So, kind of on the debt side here, it's the lowest risk, but it's the first money to be repaid. It's, I say relatively inexpensive because people have varying opinions on what's expensive and what isn't, but certainly compared to equity, when you're looking at, the cost of diluting your ownership, debt's a hell of a lot cheaper. To your question, kind of the third and to Marta's point, a lien on the company's assets is pretty standard stuff, whether it's us, our competitors, et cetera, and rarely, at least for, early stage to growth stage companies, are you going to see any kind of unsecured debt. There's exceptions to that, maybe, like a credit card line or something like that. You might find some lenders, even then.
Even credit card lines are at least taking, interest in your deposit accounts with them and requiring you to post a GIC or cash collateral. Oh. But it can be specific to certain types of assets. But if you're just taking out venture debt, you're usually going to see it be all the company's personal property now and going forward. It's not just the property you have when you sign it, but as you grow and acquire more tangible or intangible assets, it will extend to all of that. Certain lenders have carve-outs. I know Silicon Valley Bank is one of them in that IP is carved out.
Usually. In some cases we'll take a lien on the IP, but in general, we'll say we're, basically do what's called a negative pledge on intellectual property, meaning we're not going to take a lien on your IP. We're just asking that you don't pledge that as collateral to some other lender. So there are situations where we actually will take a lien on IP. So it depends. I think a big, and I'll get in a few slides kind of into more quote unquote traditional lender mentality versus maybe kind of more entrepreneur friendly lender mentality. One big difference is, as we're talking about security and collateral and those kinds of things, I know it's kind of particularly for traditional banks, it's not too uncommon to see in their playbook them asking for personal guarantees and things like that. That's something we typically, I'm not saying we've never asked for a personal guarantee, but we typically want to shy away from that. And several of our competitors would also shy away from that. And the primary reason being, if I'm really relying on a personal guarantee as a long-term security solution to help me feel good about doing this, I'm probably not differentiating myself a whole lot from what you can get from the big five or big six up here.
And as counsel, if I were representing you, I would not ever recommend personal guarantees be signed. You wouldn't want to expose yourself. We have seen situations where the guarantees are limited to the shares held in the company. In those circumstances, where it's really limited only to the shares, we can get comfortable with that simply because if all the assets of the company are pledged and the bank goes to enforce, the lender goes to enforce, the shares are kind of meaningless anyways. But other than that, we wouldn't recommend any of our clients take on personal liability. And we would, if it's holdcos holding the shares, maybe the risk is minimal, but we wouldn't recommend it. And to be honest, I don't think I rarely see it. Usually, if a bank wants it, they'll make up for it in taking, charging higher interest rates or other fees to help balance some of the risk. But, we definitely don't see it very often.
And I would say if you're faced with if you're evaluating debt scenarios from banks, non-banks, whatever, and you're being asked to provide a personal guarantee, I certainly would suggest you try and push the requirement. And if you can't make a whole lot of headway, I think at the very least you ought to try and negotiate some kind of, springing a release or something. I mean, some sort of tangible milestone that you as a company can hit to trigger the release of that guarantee. I mean, we've in the very few deals we've done personal guarantees for, that's often a feature we'll put in there to let a company kind of earn its way out of that. But I don't want to get too stuck on personal guarantees here. I think you see it a lot you see that requirement a lot from kind of just the go-to playbook from traditional banks. But I think a lot of times, within reason, I feel with traditional banks, I still think you can make a good argument for getting rid of that requirement. But I guess everybody does their stuff differently. Primary uses of debt, the simple ones would be, you're financing specific assets. Maybe you're financing recurring revenue streams. Maybe you're financing just kind of non-specific growth initiatives, whether it's ramping up hires, ramping up R&D, et cetera. In some cases, it could be, not only financing your organic growth, but also could be financing growth by acquisition. Those could be revenue stream acquisitions. Those could be technology bolt-ons. We certainly help finance both. Special situations in terms of use of debt proceeds, bridge loans, which are, whether it's us or anybody else that plays in the space, it's probably our least favorite type of lending and probably our least frequent type of lending. It's generally limited to situations where a VC firm is asking us to do it as a favor to a particular company, and they absolutely are committed to providing follow-on financing, but maybe there's a documentation period they're trying to bridge. In those situations, we'll do it. But there are others who might look at bridge scenarios, but regardless of who you do it with, bridge financing, or at least the way we would define it, it's going to be the most expensive type of lending out there.
And I think, if you're in the stage of wondering, is debt financing something we should be looking into? A need for money right away isn't necessarily the trigger of when you should start looking into it. If you've had some successful rounds of equity and you want to have, just improve your liquidity and have something in your back pocket, entering into these financing arrangements, there's not necessarily a requirement to draw on day one and to start accruing interest on day one. But it could be handy to have if you need it down the line. And shareholders may actually like it because, as mentioned before, it's not diluting their interest. So it's a way to get money into the company when you may need it without adding more shareholdings to the mix. So definitely something to think about, even if you're not in any upfront need for any cash.
Yep, and yeah, that's a good point to bring up because, yeah, sometimes as much as we want to do debt facilities and do deals and get them done, a lot of times both parties can ultimately agree that it might not make sense. I can think of, I won't name names, but there's one of Chad's client companies, super hot local company, well publicized, raised from a top tier U.S. VC, and we've had great dialogue with the company, and ultimately they just decided that given the length of their current cash runway, probably didn't make a whole lot of sense today to do debt with us. What I hope is that we've demonstrated some value to them along the way, and when they are ready to pull the trigger on something, hopefully we're well positioned. We've already, at least gotten some education on the story, but that's one where, I'm not going to look at a company if we're not truly doing something that's going to extend runway or provide cushion. We don't want to try and force feed debt on people's balance sheets just so we can earn a few, interest bucks. So, we sometimes those conversations do take a more consultative tilt, but that's all. I'll go with that one, I guess. All right, so I feel like everybody's got or a lot of companies, at least I speak with, have a bad bank story, or have had a poor experience in some form or fashion with the bank. And I'm limiting this to commercial banking. I think all of us probably at some point has had a miserable conversation from a personal banking perspective with some bank. But in terms of some of the bigger frustrations we hear from tech companies in particular, it's related to this traditional lender mentality that you see here. So looking at the first bullet point, it's frustration around, the traditional lending mindset is to want to see, a multi-year profitable operating history, or what's the company's operating cash flow to service debt, et cetera. Well, that's all well and good for an older, more established business. But when your primary criteria as a founder, or the way that private markets are valuing you most is based on revenue growth or some other metric other than bottom line, there's no point in covenanting debt, around profitability if that's not your primary metric and how you're going to be valued. And traditional lenders, not all of them, there's always exceptions, but in general, they choke on that a bit. And related to that is, okay, fine, if they can kind of get their head around that, a lot of times, or at least the criticism is that too often they'll look at your balance sheet and try and figure out from a collateral liquidation standpoint, how much could they recoup? And then the obvious frustration for tech companies is you got a lender looking at the balance sheet, looking for hard assets or fixed assets the same way they would if they're looking at a mining company, and it's just completely different, right? Most of your value is tied up in IP and or arguably enterprise value, or the nature of your recurring revenue base, things like that. So traditional lenders, at least the criticism is they choke on that a bit, because these are some of the criteria they're looking for: hard asset value and profitability or positive cash flow. And it's there are yes, we like to think of ourselves as a innovation industry lender or an entrepreneur friendly lender, and we're certainly not the only one. But the mentality that those types of that we and our peers would typically embrace would be, all right, let's go this a little differently. This is a VC-backed company, for example, that's raised money from, Omer's Ventures or Inovia or something like that. To put it in a local context, we know how those firms treat their portfolio companies, how they reserve for follow-on investments, and how they treat their companies when things go a little off plan. And you're almost at that point. We or any lender that we compete with in this kind of venture debt world, you're really looking almost at you're underwriting the investor strength and composition and the investor dynamics as much as you are the company. And you still absolutely, management teams are critically important. Technology, critically important. Historical operating performance, we probably don't have a long history. And there are certain exceptions, and that's great if you do. But at the early stages, looking at the company's ability to access capital, whether it's follow-on investment from your existing investor base, whether it's the probability that you're going to raise capital from a reasonably well-known VC firm, those are all things we're thinking about. And then related to that, particularly for companies that do have I keep harping on recurring revenue streams. All of our companies are not SaaS companies, by the way, but those are, we do work with a ton of those types of companies. And yeah, like there's enterprise value in a recurring revenue base. Now it depends on things like contract lengths and churn rates and all that good stuff. But, we do try and get our heads around sort of what's the enterprise value or what's the value here, almost like in a kind of harvest mode scenario if we had to look at that to get repaid. Yes.
Just to clarify, basically what you look at is companies that ability to raise money in the future or sell.
So say again, sorry.
Raise money in the future again.
Yeah.
Or sell the company at one point, but that's going to.
Well, or if you've already raised capital and you think if you think you've raised enough to get you at some point to profitability, or you're pretty close, maybe that's where we can kind of help bridge that gap or extend that runway. Then maybe we're not looking at. I mean, we're not expecting necessarily in that case to raise future equity. You might have enough gas in the tank to get there. It's the likelihood that if you did have to go raise additional equity, to fuel further growth, kind of what's the probability of that? And that's what we're trying to get our head around. Does that answer your question? Okay. All right. Okay. So what are the resources, or some of the resources available to early stage tech and life sciences companies? There's already one category I've left out of here, and I'll tack it on. You guys may know of others, but to really simplify it, I mean, I think of the competitive landscape for us and sort of the options available to you in the following categories. The banks, that's a pretty easy one, especially in Canada where there's virtually 6, and in the States there's 8,000, so it's a little tougher to kind of navigate those waters. But the banks, non-banks, or debt funds. So debt funds being folks like Wellington or Espresso or Hercules is out of the States, WTI or Western Technologies, some may be familiar with them. Non-banks that provide debt financing. When I say debt funds, that's what I'm referring to. Third, there's certainly a number of fintech or kind of like alternative lending platforms out there. And I think actually a couple of you, if you looked at the registration list, a couple of you are in here. Some of those are more B2C, but there are some B2B alternative lending platforms out there, and sometimes those can be good options for you as well. The fourth, and one I probably should mention that I just failed to put on the slide, would be government or government-esque type lending facilities. And I feel like I'm always learning of a new one up here, but I'm thinking, the one we probably see most frequently is stuff like, FedDev, or if we're looking at a Quebec deal, it'll be something like from Investee Small Quebec, or, gosh, do you put BDC in this category or not? I guess are they considered quasi-government? It's like there's a bunch of different programs, all with different kind of repayment scenarios. Some like FedDev, at least in a few situations I've seen, Marta and Chad are definitely going to have a stronger understanding than I will on this, but in some cases it's been like almost like forgivable debt,
or more like grants, really. Yeah,
I mean it's structured as debt, I guess, but then like nobody seems overly concerned about actually paying it back. So which makes sense. I mean, in those cases, I guess those programs are designed to foster growth and job creation and things like that. So, but fourth, I guess would be government or grants disguised as debt. If I'm failing to mention any others, somebody let me know. I guess you also could look at convertible debt from VC firms.
And existing shareholders. We see that a lot. I'm sure a lot of you have done that with my colleagues here at Osler. But definitely various types of shareholder loans.
Yep. Absolutely. And the reason I didn't put the shareholder loans up there is because we, and I think most other lenders are generally speaking going to view that with the same risk mentalities as equity, as long as those shareholder loans are subordinated to the primary lender's security interest. In that case, and as long as there's no big looming repayment date that's supposed to happen before the senior debt gets repaid, most lenders will be pretty flexible with.
Most lenders are definitely flexible, but if you have a lot of shareholder loans out there, you might need to consider whether how your shareholders are going to be comfortable with it. But I've never seen a lender actually restrict the conversion. It's usually there's just often restrictions on repayment.
Yep. A few considerations when choosing a debt partner. The list could go on and on. Try to distill it down to about 5 here. One, and a lot of this is just kind of common sense, right? But reputation. Ask for client references. Absolutely, ask for CEOs, CFOs, whomever from some of their current client companies, and call those folks and reach out and ask how their experience has been. And it's always fun when you can have a conversation with a company that's actually gone through a tough period with a lender, and ask them how that particular lender behaved. Did they really put the screws to the company at the wrong time? Did they try and be reasonably good partners, reasonably patient, or at least as patient as debt folks can be versus equity folks? Ask those types of questions. Ask about their response time, what's the client service experience been like, all that. Because while this is not taking on debt partners by no means is, I think, as lofty a consideration as who you're choosing for an equity partner. That's almost like a professional marriage almost. The debt folks, you also don't want them. You don't want to take on an unproven partner. You don't want to take on a debt partner that's got a crappy reputation out there.
One thing to think about, as soon as you enter into debt financing, most of your out of the ordinary transactions will likely need to be approved by the lender. So it's really important to make sure that you have a good working relationship with them, that, they see eye to eye with your business model, because you don't want them, you want to make sure that going forward, while you will likely need their consent on any major transaction, that they will work with you on it. So definitely important consideration.
Yep, a very good point. Related to this would be experience and track record. Does this debt partner understand what the hell I do? Do they is this the first time they've worked with a tech company? Is this a new tech banking group that they just launched in the past year? Not necessarily a bad thing, but it's something that might, if it doesn't give you pause, you may just want to get a little more clarification on that and see maybe that individual, even if it's it might be a new group for that bank, but maybe that individual has a lot of experience, and that could give you some comfort. Costs, of course. Terms. What's the interest rate? If there's a warrant requirement? How dilutive is it? Are there fees? Just make sure you understand all the costs, and have the lender walk you through, or your lawyer, if they've seen plenty of that lender's term sheets. Osler is a great example. Have them walk you through kind of what all the costs are, and if there's questions, always err on the side of asking us. Scalability. That's a big one. Most early stage tech companies are pretty hell bent on growth. And is this a debt partner who has the stomach for growth? Is it a partner who can grow with me incrementally? So like a good example would be if it's a smallish debt fund, they might be a great near-term solution, no question. But you also want to talk to them kind of about what's the house limit? When are you guys going to get tapped out? If fine, you gave me $500,000 today, but when I need you for 5 or 10 or 15, when are you going to get tapped out? Because you don't want to go through this process every year where you're changing debt partners every year, because God forbid you're growing. That's a great problem, right? So you want to ideally saddle up with a partner who can scale and grow with you. Network is one where it's almost a foregone conclusion that you should get competitive terms. When I'm going back to the costs and things like that, cheapest isn't always better, but you need to get competitive terms from your debt partner. Assuming that's a foregone conclusion, which might be a little generous. What else? What other intangibles does this partner bring? Is there are they well connected in my particular industry sector? And by well connected, does that mean they're connected to peer companies, CEOs of other companies that I want to talk to and I want to meet with? Are they well connected, or at least well known in certain investor circles? Things like that, where collectively sometimes those intangibles can be really valuable to a company, and then sometimes they aren't. Some companies look at this stuff from a purely transactional perspective, and that's okay too. It doesn't make them dumb, doesn't make them bad companies. Just some folks tend to value some of this intangible stuff more than others. And there's never a wrong way to do it.
Yeah, I get asked fairly frequently, taking, with specific consideration to some of the legal points in these agreements, which bank would you recommend I go to? And I think I just echo a lot of what Wynn said. A lot of the paper that you're going to see from Silicon Valley Bank and all their competitors is very similar. And I really, I would never recommend focus be put too much into what are the covenant packages that come with this or what are the defaults that we need to be concerned about, because it is quite similar across the board. What really I always recommend is the reputation and the working relationship of the banker, because you will be dealing with them on an ongoing basis, and the economics of it. Is it your most cost effective option? And those are really the things that you should focus on, because other than personal guarantees that we talked about, the specific legal terms are going to be very similar as you look at all the competitors in the industry. They know what each other, they've seen everyone's papers really in terms of they know what their competitors are offering, and they're going to offer something similar. So save and except for personal guarantees or really restrictive financial covenants that you just may not be able to comply with. The focus really should be on the working relationship, the cost, and what the future opportunities look like with this partner.
Yeah, agreed. And it's like legal fees. Raise your hand if you like paying legal fees. Nobody does. Nobody likes paying banks. Nobody likes paying lawyers. But it's, if you are going to pay those fees, what other value can you extract from this? And this is starting to sound like an Osler infomercial, and it's not intended to be, but I'll put Chad on the spot. If you're a company up here and you're looking to raise outside capital, how many other lawyers up here can actually make a call to Vinod Khosla or something like that in the States? Not very many. He and his team can. And they've done, dozens and dozens, I forget the number year to date, of new equity financings for clients up here. Chad's well known in the Valley as well as up here. So if I'm, it's similar with your bank or your a CPA firm or whatever kind of professional partners you're choosing. Figure out what additional value you can extract out of that. You're paying for this stuff. May as well get as much value as you can out of it. Where are we next? So there were. Let me just see here. I want to leave plenty of Q&A open if there is any. What I plan to do here is I can walk you through, if it makes sense, just a couple of and these are plain vanilla sort of debt use cases. One or two would be kind of venture debt specific. The other would be, pertain more to working capital lines of credit. That might be, recurring revenue-based lines. It might be receivables-based lines. I can also just pause if y'all want to kick around other ideas, but if a couple of simple use cases make sense, thumbs up, yeah? Okay, all right. And if you want to get into more detail on some of this stuff, please interrupt me. Some of you are going to be already pretty well versed in this, and some of you won't be versed at all. So venture debt, that's one where a lot of folks define it differently. Our definition isn't necessarily the right one, but when we think, at least at SVB, of venture debt, it's predicated on a company having VC backing. The caveat to that is having VC backing is not a prerequisite to working with us. It's not a prerequisite to getting debt financing. But for venture debt, at least the way we're thinking of it, which is really as a supplement to a non-dilutive or minimally dilutive supplement to an equity investment that you raised, obviously then the venture debt model is predicated on you raising equity. Could be equity you've already raised. It could be a future round where, good example is, kind of here, some of these bullets, I tried to illustrate it, not very well as it turns out, but let's say you're targeting a $10 million Series A round. Maybe you don't have to do all of that in equity. Maybe you do 7, 8, in equity. Somebody like us layers in, the rest in debt. You've gotten to your $10 million capital target. You've suffered less dilution than you would have if you'd done the whole thing in equity. And then the other side of that is, okay, maybe you do take all 10 million in equity. Well, maybe you want to layer in some cushion on top of that so that if you decide to pursue a couple of different angles before your next round, you've got some cushion to do that. Or maybe by taking debt and extending your cash runway before you have to go raise money, maybe you get on the other side of some kind of value driving milestone. Could be a revenue milestone, could be a developmental milestone. It could be milestones I'm not even thinking of right now, but if there are things that are going to drive a company's value, and venture debt can give you a little more gas in the tank to get there, sometimes it can be a beautiful thing. And to Marta's point earlier about not force feeding debt to people, day one with some of these credit facilities, in some cases our companies don't end up using it. That's all right. We look at this, and a lot of other folks look at this with a long-term view. And so sometimes doing a venture debt facility that never even gets drawn is a way for us or others to start a relationship with companies, and we're okay with that. I mentioned, runway extension. That's the term that probably gets used most frequently when people are contemplating venture debt. And then, the other things, unforeseen things like product delays, or, if you're in the, life sciences world, if there are regulatory approval delays, things like that. Like sometimes that's when having, a little extra gas in the tank from a debt facility could end up being really, really valuable and prevent you from having to go out and raise more equity at a terrible time.
Yeah.
Yes. Yeah, for sure.
So let's say you raise a $3 million round and you raise 7.5 from investors and 2.5 from venture.
Yeah.
How do investors feel about that? Like when you don't take all the money from investors, you know what? So they really want to do.
Yeah. No, I mean, that's a very relevant question. And we never want to be in the business of pissing off investors, because the probability is we're going to work with those same investor groups across multiple companies. So it's one of those where we generally know how most investors feel about leverage in their portfolio companies, and there are some that are adamantly opposed to it, and there are some it's a no-brainer. Every time they make a new investment, it's like they just assume that the company's going to layer in some debt from us or others alongside
We
there.
see it encouraged all the time, actually.
There used to be a regional distinction. So people used to criticize East Coast U.S. VCs for being so debt averse, and that accuse West Coast VCs of being a little too cavalier about it. There's probably something somewhere right in the middle is probably the right place to be, right? But your question was, how do investors feel about it? I think the simple answer is you're going to get varying opinions, and then the question is how much leverage is right. I mean, some have crazy appetites, others don't, but I wish I could give you the one size fits all answer, but there just isn't. It really depends on the nature of the VC firm, how experienced are they with, or the angel group, how experienced are they with using debt or leverage in their portfolio companies. And if they're adamantly opposed to it, we're not gonna try and go solicit their portfolio companies and piss off the investor. Let's see here. For one other, and this won't apply to all of your industries, I understand, but a handful of you it will. Another type of debt financing instrument that we and others use quite a bit is a recurring revenue-based line of credit. So lines of credit, while we'll happily still do accounts receivable-based lines of credit and things like that, and a lot of our that's a big business for us. But proliferation of SaaS models, things like that, these types of companies aren't necessarily carrying big receivables balances on their balance sheet, so they can't finance those. But there is real value to some of these recurring revenue streams. So if you're a SaaS company and looking to layer in some debt, this is oftentimes a pretty good way to do it. And we do a ton of this. We're certainly not the only game in town, but we do a ton of this. And if you ever want to talk specifics about or have questions about, us or others in the space who you should talk to, I usually give folks a couple of alternatives when they're talking to us.
Yeah, maybe should we talk about some shred receivables and
Yeah. And then, exactly right. So shred, I mean, it's I'll go over this quickly, but it is a request we get a lot from our clients up here. Is to help them finance their shred claims, whether that's filed or in some cases, maybe even finance their accrued shred. How many of you actually use the shred program here or have used it? Okay, so all right. So most of you are well versed in this. And look, shred financing is not something we're out pitching as a standalone product. There's plenty of boutique financiers that'll do that stuff, but we will happily do it in conjunction with another credit facility. So if you're already doing a line of credit or a venture debt facility or something else with us, and you want us to do the shred, well, that's pretty easy for us to do.
Yeah, definitely there are, if that's something you want as a standalone product, there are
lots of options.
There's tons of options who would use that as a receivable for their financing.
Yep, absolutely. And then, this is one where, the landscape continues to evolve. And so maybe there's a couple of you, I think, that are actually here. And if you want to opine on some of this, fire away. But you're seeing you're seeing more and more fintech or alternative lending companies and platforms out there, both in the States and in Canada. And boy, there's so many that a lot of them we actually work with. So it almost seems crazy that in some cases we're helping finance companies that are really trying to disrupt us. But that's just the nature of being in the innovation space, right? So as far as specific recommendations, I'd probably defer to Marta or Chad or anybody on their team in terms of local folks you ought to talk to if you want to explore that route. But just know they are out there. The number of them is increasing on a monthly basis, and some I'm sure have stellar reputations. Some you may want to avoid like the plague, and I think that's where you can lean on your lawyer or your CPA or whomever to kind of help give you some guidance there.
Yeah, and similar with shred financing, some of these alternative financings, as you get into specific equipment financing or receivable financing, I know Silicon Valley Bank, a lot of them are in conjunction with traditional debt facilities, but there are companies or financial institutions that are offering this as a standalone product. What's useful is when you're focusing on financing something very specific, it can often be a little quicker to put in place. And sometimes they don't have the same covenant package that you get with traditional financing. So it helps in the short term. It doesn't necessarily have the same restrictions on your business. The amount of financing that you're getting may be a lot less than traditional term financing or venture debt, but definitely something to consider if you have, the big ones that jump out are really equipment financing and receivables. But if that's anything that applies to your business, it's definitely a good option to give you a little bit more liquidity on an expedited basis.
Yep. So I think we're at 5 till right now, roughly. I want to leave plenty of time for Q&A or anything like that. Yeah, please.
Can you go through a term debt scenario? Just give me an example of.
Sure. So
Could you just go through a term debt scenario so they get this on the recording?
Yeah, of course. This is my lame precursor. Of course, every deal is unique, but to give you some rough parameters in terms of kind of what you'll typically see out there. So if we're talking like venture debt term loans, right? Typically, you're going to see, we'll start with total term, right? And total term can be divided up into some kind of interest-only period, or an interest-only draw period where, back to our conversation about not force-feeding all the debt day one on your balance sheet, maybe the lender gives you some amount of time to draw it at your discretion. And at the end of that period, whatever that is, it amortizes over a certain period. So we'll start with the total term. You're generally going to be looking at, 4 years, maybe 3 years in some shorter cases. And that could be, slice and dice a few different ways. You might have no interest only period, or you might have, on the front end, 6 months, 12 months interest only, sometimes a little longer in rare cases.
And interest only is usually your draw period also.
Correct.
So you can draw over that same time.
Correct. And then, interest only period plus amortization period, again, your good rule of thumb is 3 to 4 years. There are, that's typically the way of the banks that play in this space. That's the way you're going to see most of them do it. The non-banks, because non-banks are non-regulated, they're bad. Just it means they're non-regulated and aren't subject to a lot of the same scrutiny that banks are. You might see them willing to do some things structurally. They're a little different. So Wellington's playbook is doing like a 3-year interest-only type facility where you just pay a big balloon payment at the end. Some folks really like that. Others don't like paying the costs associated with that. But it kind of, it's like really up to you as the entrepreneur, like what's most important to you in terms of structure versus cost. And we like to try and be, or try and help, give proposals that strike that balance. And a lot of times we're successful, but sometimes we're not. But even in those cases, like the debt funds, I don't see much stuff out there for early stage tech companies that goes beyond 4 years and maybe 5 in some rare cases. But so that's the life of the loan. Costs, okay, there's a whole bunch of different levers that your knobs that lenders will turn. Most simply, like what's the interest expense? So, and then what fees are associated with it? And then venture debt usually is going to have some kind of warrant component. And for those who aren't familiar with that, warrant is basically just a stock option. You're giving the lender the right to purchase X shares of your stock at a predetermined price. So we'll talk about that. And, interest rates, it's all over the place because, again, the banks that play in this space, we're going to do it a hell of a lot cheaper, not because we're bad or not because we're good and they're bad. Our cost of capital is so much cheaper than a debt fund that has to go out and raise outside capital and all that stuff. So that's reflected in our pricing. So when we're looking at venture debt, I mean, you're generally looking at, probably mid-single digits in terms of interest rate. The caveat there is, there might be a debt fund or two you're talking to who are asking you for, what's all in, 12 to 15%. But maybe structurally they're doing some things for you that we aren't willing to do. Or maybe they, are trying to use check size as a differentiator for them. And in doing so, they're still going to make you, pay a premium or whatever they need to hit their IRR hurdles. So, again, on the high end, when I look at, including the debt funds who play in this space, there's always exceptions, right? But in general, I'd say the high end, what you're going to see is like mid double digits in terms of interest rate
Yeah, I think I've seen recently up to 18, 19% but again, those are debt funds, not banks.
Yeah, but generally we're going to be doing something that's kind of in the mid-single digits. Fees with any lender, you're probably looking at an upfront commitment fee of some sort that could, it ranges from, I've seen some no fee structures too, but like mostly, a good rule of thumb would be less than 1%. So, $1 million deal, probably 10 grand or less for an upfront commitment fee. Again, these are just guidelines and there's always going to be exceptions. The warrant stuff, that's one where you're going to see probably most variability. Well, you see a lot of variability in the interest rates. Warrants, it depends on, how much is the lender really factoring in potential warrant gains into their expected return on this debt facility. And instead, they're looking at it more just kind of as it's added upside if the company has a great exit, and you get a lot of different you get focused on a lot of different parts of that spectrum. I know, for example, when we're looking at warrants, for your prototypical Series A venture-backed company, it depends on a lot of things. So it depends on depends on the investor syndicate. It depends on the company's, again, some of these earlier things like the whole risk profile, like how accessible is future equity going to be to this company? What space are they in? Are they just another Me Too, or is it something that's actually really differentiated? Yada yada. So all these things like factor in, but I'd say, and certainly size of the loan makes a big difference, and size of loan relative to equity raise and all these things. But just in general, for back of the envelope math, probably looking at a warrant that would equate to, on a fully diluted basis, somewhere between 0.25% to 1% of the company. 1% for us would certainly be on the high end. But then there's certain debt funds out there where I've seen them on a fully diluted basis, their warrant would equate to a few percentage points. And again, it's not because they're bad people or just really violating usury laws or things like that. It's because they're probably doing something structurally that's a bit further out on the risk curve, and they feel like they should be compensated for that. Does that answer your question about the rough parameters? Sorry, one other I should mention, because I think it's pretty standard for whether it's banks or debt funds, is from a just an ongoing administration perspective, like how much do I or does my CFO or my VP Finance going to have to spend kind of just on a monthly basis, keeping that lender informed and happy and all that. And so the general requirements you're going to see is, a lender's going to ask you for monthly financials, company prepared financials, annual either audited or reviewed financials. Typically, we're usually fine with review for companies at a much earlier stage. Once you get to a certain point, it's time to go ahead and pay up and get the audit. But does it make sense for a super early stage company to necessarily pay for audited financials day one? Our stance on that usually is if their board's okay with reviewed, we're fine with reviewed. And I think most lenders, would probably echo that. And then other things like Marta alluded to earlier with various consents and things like that. Like if you're planning on making acquisitions or doing things like that, think about just the time it's going to take to get the written consent from your lender. It's something that should be turned around pretty quickly, and a lot of times that does work out. Sometimes it doesn't, and that's when it can really create some animosity between companies and lenders. Did that help?
Yeah.
Okay.
Are there any other questions?
Fire away, man. Fire away. Yeah, Louise.
Do you see any of the Canadian banks moving into your space aggressively or even seriously?
Yeah, I mean, we see. There was. I think at some point they've all technically been in the space. I've got some. I worked for Royal for 5 years in their tech banking group in the States, and that was from 02 to 07. So I've got some perspective there. They've had their KBI group for 25 years. Others, have either launched for the first time or relaunched tech banking groups. I think every single one of them has done that now.
Yeah,
and we see that in the States too. I mean, and this happens every time. I won't say every time in Canada because I don't have historical context there. I'll say it in a U.S. context. We see this every time tech gets hot in the States, and tech gets hot, and the street expects banks to continue being growth stories. They're looking for what's an easy way to do that. A lot of these banks are in the States are new entrants into the market. A lot of them are viewing it really as a deposit gathering exercise because your typical tech company is going to be far more like their deposit to debt ratio is really going to be like inverse of a more traditional company. And so a lot of banks who are really, I won't say desperate for or like hell bent on deposit growth, tech's a pretty good place to look. So that's a long-winded answer. The short answer is yes. We're always seeing new competitors. We're seeing also, you see competitors go away too. And the next downturn, which I'm not wishing a downturn for any of us, but that's actually when we tend to pick up market share. And because we can't just go running for the hills. We've done this for 33 years. We're committed to tech. We don't have other businesses or business units we can run to. And not that all of them are going to do that, but it's just a lot easier if you already have a bunch of other more traditional business units in your bank. But yeah, I anecdotally, I'd love to hear whether it's today or some other time, kind of what you all are hearing. I would assume most of the banks here are soliciting or at least meetings with you and looking to do stuff, but I haven't seen enough term sheets from them yet to get a sense for kind of what their playbooks are. I see things spotty, but my data set I think is a little too limited to really be able to say what their playbook is.
Any of the major banks in Canada do this type of financing. I think where we run into trouble, and probably why they're just one of the main reasons why they're not as popular, is the big institutional banks in Canada are a lot more conservative. So what they're able to offer you is just not quite as competitive as what you might get from a Silicon Valley Bank or a Comerica or some of the other debt funds. They'll have. That's where you may see personal guarantees come up. You'll see more financial covenants. It will just be, I think that they just struggle to compete with what some of the other more focused lenders can do, which is why you just don't see as much. But yes, any single one of them will be able to lend. It just might not be on the terms that you want. Yeah.
We'll wrap it up there. It's just a couple of minutes after one.
Okay.
Meetings stuff to get off to. So, Whit, thank you very much for making the trip. I guess you'll have to chug this
airport
before your flight. But thank you for taking the time
thanks for having
to be here. Just a couple of administrative things on your tables. You have a feedback form. If you can just take a couple minutes to fill those out. Those are always useful information for us to kind of help make these sessions better. Also, if there's other topics that you'd like us to cover, we've been pretty good about getting a range of topics over the last couple of months, but if there's certain topics that you want to see us cover, please fill that in and let us know. We're going to take a break in December. We've got the holidays, and it's usually a busy time, but we'll be back in full swing in the new year, so stay tuned for the next invite for our next luncheon. Thanks again.
Thank you all. And also, if we didn't have time to get to questions or you have debt-related questions later, my email's there, my mobile's there. I'm generally up here a couple times a month. So I know I'm back up here next week for 2 or 3 days. If you want to catch up for a coffee or something like that, just shoot me an email anytime or give me a call. Thanks.
Thank you.